My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video where I review subscriber portfolios. It's one of my favorite series here on the channel. It's a great way to see how different people all across the globe are investing in this strategy. In today's Review My Pie, we're going to review 4 portfolios. The first from a 25-year-old here in the US, the second a 70-year-old from Korea, and then the third a 19-year-old from the United States, and then the fourth a 22-year-old from the United States. As always, the timestamps are in the description below, and if there's portfolio links, I've included them in the description below. As always, everybody, I'm just another guy here on the internet. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, everybody, I don't pre-record or pre-script what I'm going to say in these Review My Pies. I'm reviewing them for the very first time. So it's really interesting for me to see what people are invested in. And so my reactions may be a little bit different depending on, the portfolio, because I don't look at them in advance. This week is going to be really busy for my wife and I. We're finally going to take vacation for the first time really in a year and a half. So we're really excited. We're going to go visit family up in the Rocky Mountains. This week is kind of busy, and I just wanted to make sure that I took the time and recorded a video because I wanted to make sure that there was a video for Sunday. One of the cool things about having a YouTube channel is I get to interact with all of you. I read every single one of your comments. I read all of your emails, and it's so cool to interact with all of you. One of the cool things about having this YouTube channel is everyone has a different perspective on investing, and that's a good thing. We shouldn't all be thinking alike. The world would be very boring otherwise. We should have a little bit of personality out there. But everybody's not always going to agree with everyone, and I think it's cool to see how different people have different perspectives on different parts of the market. And for me, sometimes I get really, really random questions, and I just kind of shake my head and think, well, I don't know. I mean, I'm not an expert on everything, but it's sometimes fun to get some of your questions where I'm just like, I have no clue, dude. Like, that's a great question. Google. Like, I mean, I don't know. I don't have all the answers. And sometimes when I get some of these questions where I'm just like, what? Huh? It kind of makes me feel a little like this.
Did it surprise you what she said yesterday?
Wow. Wow. Next question. See ya.
Oh my gosh. I'm sure there's somebody that's brand new. This is the very first video that you're watching on my channel, and you're just like, what the hell? What did I just watch? For those of you that have been watching the channel for a while, you know that I'm weird. Okay, so cool. All right, the first portfolio is from Caleb. He writes, "Hi Jake. First off, I just want to thank you so much for your YouTube channel. It really lit a fire in me, and my goal is to one day live off of the passive income off my portfolio from dividends." Well, Caleb, thank you so much, man. I really, really appreciate you saying that. With that being said, I'm 25 years old and currently in pharmacy school and will be graduating in 2 years at 27. So I'm not working much right now. I'm not investing much currently, but I just opened a portfolio at M1 Finance and put $100 in and plan to be investing 50% of my income once I become a pharmacist. Average salary, $100K. My goal is to be retired off of dividends by 50 years old, as well as passive income from real estate. Okay, that's cool. You're doing real estate and dividend investing. That's exactly what my wife and I do. I would like your advice on my portfolio because I've seen the general consensus is that your portfolio dividend yield percentage should be around 4%, and mine is only 2.4%. I'm wondering if it is too low or if I have too much invested in high dividend ETFs, etc. I'd love to get some feedback from you. Thank you again for your videos. Best, Caleb. All right. Well, Caleb, thank you so much, man. I think there's a lot of great stuff in here to unpack. First off, you're going to be a pharmacist. You're going to make a really high salary. Well, this is all relative depending on where you live, right? If you're in New York or Los Angeles, 100K is not going to go very far. But if you live in the Midwest, or if you live in a state where, the median, salary is maybe 60K, you can do a lot with 100K. So that's the very first thing. It's all relative. So if you're watching this video from somewhere where 100K is a lot or a little, it all depends on your expenses for the most part. In terms of your time horizon from 27 to 50, just under 25 years, yeah, I mean, the important thing that you want to focus on, if you have over 20 years, 23 years is a long time. It's a long time. And you might be surprised if you're already investing into real estate. I would leave it open that you might even be able to reach your goal sooner. You might even be able to reach your goal by 45, 42, 43. When my wife and I were first investing and looking to reach financial independence, the retire early part is optional. We may still side hustle or do other things that we're passionate about, but we're going to become financially independent much sooner than we originally thought. And a big part of that has to do with our investments in real estate. So it's not for everybody. Do-it-yourself real estate investing is not for everybody, but it is definitely a way to turbocharge your returns and help you reach financial independence much sooner. Let's take a look at your portfolio. It looks like the chart here is actually not working with M1 Finance. I don't know why that's happening. It probably has to do with some of these icons. I don't see this very often where the chart is not showing up. So or the graph here. I don't know why that is, but we can take a look and see, okay, your dividend yield is 2%. This all depends on the current price of the shares of your portfolio. So it really can fluctuate. 6 months ago, my portfolio was yielding almost 4%. Now my portfolio yields 3%. So the market's kind of crazy. You have 38 holdings, which I think is manageable. 38 is not bad. You're first starting out. I personally wouldn't go over 38 if you're just starting out. You have a low expense ratio. This is a good expense ratio. You're broken up into dividend ETFs. You got tech, consumer, telecom, real estate, industrials, healthcare, financials, and utilities. So Caleb, before I dive into your actual portfolio, I think it's important to understand that the investing part is only half the battle, right? The part where you're focused on right now is getting your education, your side hustling in real estate. That is almost more important than picking the individual stocks. These stocks right here, they're your vehicle. Your real estate is your vehicle. You want to make it as simple as possible. You don't want to overcomplicate things. And in my experience, when you're setting up your portfolio, it's very possible that you're going to change things around. So my first bit of wisdom would be keep it as simple as you possibly can. And that goes for everyone watching this video. And one last thing that I would mention here with the dividend yield, I don't think it's necessarily a bad thing. Over 20 years, a 2% dividend yield, it keeps you flexible, right? So 2% is obviously going to be very difficult to live off of, but it also provides you the option that if you're investing into companies that are yielding maybe only 2%, in most cases, they're growing faster than a company that is growing, has a current yield of 4 or 5%, right? So you definitely have options when it comes to your total portfolio, because you always could, if you needed to, you could always reposition out of your growth stocks into value stocks in 20 years. So that's something that you could do. So I really wouldn't lose sleep at night over, oh, do I have the perfect dividend yield for my goals? Like, I honestly, I wouldn't overstress that. If this was maybe a 10% dividend yield or an 8% dividend yield, we need to have a conversation. But a 2% dividend yield, I don't think you can really go wrong. So let's take a look at your ETFs. You got SDY, that is fine. VUG is a growth ETF. The DGRW is also a very good growth ETF, VTI and Noble. So for a 20-year time horizon, I really like VTI, I like VUG, one of my favorite ETFs. And so for your time horizon, in my opinion, I don't think you need DGRW and you don't need Noble. That's just my opinion. What I would do is I would replace DGRW, maybe even SDY and Noble with SCHD from Schwab. That's something that I definitely would consider. And then increase your position maybe in VUG. I also like VGT. It's the information technology ETF from Vanguard. And I also really like VTI. So here's the one thing that I would say. If you're unsure about what you want to do, the best thing in my opinion is to load up on the total stock market. Because then what you could always do later is you could either reposition out of the total stock market or you could always adjust it later. So if you're unsure, I personally would focus on, increasing your exposure to total stock market. I think Noble is a great ETF. It has a high expense ratio, and it really is. It doesn't necessarily always beat the S&P 500. Like it's difficult to live off of the dividend from Noble, and the same thing with DGRW unless you have like 30 years. So that's just my opinion. Let's take a look. VGT. Okay, beautiful. This is the technology slice here. VGT is in here. That's great. Visa, Microsoft, Apple, I think these are absolutely fine. I personally really wouldn't necessarily change a thing. I like it exactly how it is. Consumers, let's see, you got your Coke, your Walmart, your McDonald's, McCormick, Nike, Hormel Foods, Costco, and Pepsi. Yeah, man, I think this is great. The only thing is you have to understand Coca-Cola is growing much slower than McCormick, Nike, Costco, and Walmart and McDonald's. So you actually have your slowest grower at the highest allocation. So the question is that what you want, right? And for 20 plus years, I don't necessarily think that's probably the best route to go. Now, the reason why I say that is because I'm focusing on the total return. The total return would be the capital appreciation that you're going to get plus the dividend. And over 20 years, man, I'd look at a Costco, I'd up McDonald's, Walmart. I would bring down Coke and, I bring it down lower. That's just my opinion. Your telecom, what you got in telecom, you got AT&T, Verizon, Disney. I think you sent this portfolio a while ago, Caleb. I've shared my thoughts on AT&T and why I sold out of AT&T. AT&T is a pure telecom play. The telecoms that I like Verizon and I like Comcast. Disney as well. Yeah, that's just my personal opinion. And I've talked a lot about that on the channel. Let's see here. Real estate, you got V&Q, love it. DLR, love it. Realty Income and American Tower. Something that you could check out. I've shared some videos on some high yielding REITs that I really like. I don't necessarily know if it'll fit in your portfolio with your time horizon. As it stands here, I like these. The only one that I would maybe consider taking a look at is Prologis. It's a industrial REIT. I really like industrial REITs. But yeah, this is absolutely great. There's really no red flags. You only have 10% in real estate. Real estate is a non-qualified dividend. Man, you're looking good. Industrials, you got my favorite here in waste management. This is exactly what I was hoping and wanting to see. You got your Lockheed Martin. You got your Emerson. Okay, Emerson's a good one. General Dynamics, good. In my opinion, you may even consider swapping out, like if you were to like make updates to your portfolio, say you reevaluate Emerson Electric and maybe Caterpillar. I think Caterpillar would be a little bit of a better, or you just add it, right? You just lower Emerson and you add Caterpillar. But I really like Caterpillar for a 20 plus time horizon. Let's see, you got your healthcare. Healthcare, you got Johnson & Johnson, AbbVie, Stryker, Medtronics. I own every single one of these holdings. Okay, now I want to share something with you that I think is applicable for everybody. What percentage do you have in healthcare? Healthcare, you only have 10% in healthcare. Dude, Caleb, you're going to be a pharmacist. What is your specialty? You know the pharmaceutical industry. Why is healthcare such a low percentage in your portfolio? You should be investing in what you understand. What I would encourage you, and everyone, maybe you work at a construction company, maybe you work for a real estate company, and you understand that industry better than other industries. I would encourage you to invest in areas that you have a deeper understanding than most regular people. As a pharmacist, you're going to know what companies are the best, companies in the pharmaceutical industry, right? And that's what I would recommend, investing into those kind of companies with confidence. And I think you're going to do a lot better when the market corrects because you have conviction in these companies and you understand them. That is why I love consumers so much, is because they're up in your face. But for healthcare, most people who are not pharmacists, they don't really have healthcare products up in their face. And so this is something for everyone, depending on your industry and your specialty and what you specialize in. I would encourage you to invest heavier in those areas because you understand them. If you were a banker, right, you would invest more into financials because you understand the financial system better than your average person. Let's see here. You got Accenture and you got VFH. I think that's absolutely fine. VFH, I like VFH. Utilities, 1%, VPU, PPL, and Linda. Okay, so yeah, I think this is fine. In terms of utilities, I really like Duke and Southern Company. Duke and Southern Company, I'm a bigger fan of than PPL, for example. But for, I think you can't necessarily go wrong. It's just a personal preference. But if you do have a longer time horizon, I think Duke is definitely a utility that you should check out. Well, Caleb, thank you so much, man, for sending over your portfolio. I think you're off to an amazing start. One thing that I would say, I think, I just listening to my gut here with reading your email, if you're already investing into real estate as well, I would plan for the pleasant surprise that you may reach your goal much sooner than you think. And so having that backup plan is going to be really, really important. So Caleb, thank you again so much for sending over your portfolio. The next portfolio here is from Paul. Paul writes, "Hi, Jaco. I am a huge fan of your channel, and these days I enjoy watching your videos almost every day." Paul, thank you so much, man. That is so kind of you to say. My wife and I are in our 70s, and we're going to stop our business and invest about $3 million of our savings in US dividend growth ETFs to enjoy financial freedom. We need your help. We have no experience in investing in stocks or ETFs. I'm sending you my portfolio of my family and would be very grateful if you could review it. I'd like to book one-on-one time with you to review my portfolio. Before that, please review my family's portfolio and please feel free to book me anytime after 7 p.m. Korean Standard Time. After your booking, Okay, cool. So Paul, you're 70 years old. You have $3 million that you're looking to invest into stocks. So at this point, with a $3 million portfolio, you may want to very likely seek professional financial advice. $3 million is not a small amount, okay? And so I think it would be very important to understand your goal at this point. You're 70 years old. What are your short-term and your long-term goals? What do you want to do with the money? After you've understood your goal, it'll make it so much easier for you to understand what you want to do with your money. If you talk to a financial advisor, very likely they're going to focus on risk mitigation. They're going to focus on helping you foolproof and risk-proof your portfolio. They're going to talk about asset classes. They're going to talk about investing into bonds versus, the equities. They're really going to talk about diversification. So at your age, with a $3 million portfolio, it's all going to be about diversification and preservation of your portfolio. All right, so let's take a look at your first portfolio. It looks like it's the FANG plus a few ETFs in here. You even have the dollar amounts. So this portfolio equals $2 million. You have a lot in Microsoft, Facebook, Google, Amazon, and Apple. You even have the S&P 500 in here. And I see down there at the bottom that you also have the total stock market. I think it's important that you do diversify, that you do have exposure to the greater stock market. In my opinion, so I can't give you, really advice on what you should do, but I can tell you what I would do if I was in a similar situation. What I would do if I was 70 years old and I had $3 million to deploy, I would spread it out. The majority would very likely be in ETFs because $3 million will be more than enough for me to live off of. I don't feel like I need to take the risk to invest into individual stocks. That's just my opinion. And so I would invest heavier in high quality, high dividend ETFs. ETFs that are paying, 3-4%. Now, all depending on your expenses, what you're looking to do with the money, that's personally what I would prioritize. I'd prioritize ETFs like SCHD, VYM. You could even look at cover call ETFs that have a very high starting dividend yield, like a NUSI, ticker symbol NUSI. I also like the JP Morgan cover call ETF and JEPI. Those are things that you could take a look at. But what I would definitely recommend is don't speculate. At this point in your life, you don't need to speculate. You don't need to gamble. You don't need to roll the dice. And so really focusing on conservative investments would be, in my opinion, the wisest choice. Now let's take a look at your other portfolio here, your dividend growth portfolio. I may have spoke a little bit too soon, but this is exactly what I was referring to. You got the ETFs that I was talking about. You got the SCHD, you got the VYM, you got the DGRO, you got the S&P 500, the NASDAQ 100 ETF, the total stock market. This is absolutely great. I think this is the right approach. Like, in my opinion, I think this is a really, really good approach. Something that you could also take a look at are those high dividend ETFs, which I just mentioned in those cover call ETFs. If you wanted to have maybe, a couple 100,000 in those, you're going to get substantially more dividends on a monthly basis than you would, for example, with the S&P 500 or with VIG, the dividend appreciation ETF from Vanguard. But I think these ETFs, I like this a bit more than the last portfolio that we were just looking at. So I like that it's diversified. I like that you're focused on very high quality ETFs. These are all really, really great ETFs. Once again, the most important thing here is understand your goal. What are you looking to do with the money? Are you looking to spend the money today, or are you looking to hand that down to your family? What is your goal with the money? Really focusing and understanding at 70 years old, you're no longer in wealth accumulation mode. You're in wealth preservation mode. You don't want to take risks at losing the portfolio and investing into speculative investments, which you are clearly not doing, as I can see here. Paul, thank you so much for sending over your portfolio, and best regards to your wife. Thank you so much for the kind words. The next portfolio is from Brandon. Brandon writes, "Hello, my name is Brandon. I'm 19 years old from Ohio, and I want to move over from Robinhood to M1 Finance. Between college and soccer, I don't have much time to work, so I only invest about $100 per month, although I have about $1,000 saved up in my Robinhood account. My goal with this portfolio is to never pull money out until it pays enough dividends to sustain a healthy lifestyle. Therefore, I mostly avoided sectors with uncertain futures like the oil industry and residential REITs. Thank you so much for taking the time out of your day to review my portfolio, and I look forward to hearing your thoughts about dividend investing." All right, well, Brandon, thank you so much. Well, let's see here. So you're 19 years old, you're going to college, you're investing $100 per month, so that's a good amount. And I like the idea of thinking in the future and seeing, okay, what industries are going to perform better than others? So the oil industry, yes, there's a lot of disruption happening. With residential REITs, yeah, I can understand that. I think with residential REITs, I think there's still a future for residential. I think the one that's a little bit challenging is office REITs. Office REITs are especially because of the pandemic. It's kind of interesting to see how things are going to shape out. But let's take a look at your portfolio. It looks like, I don't know why the graph is not working today. I don't know if it's something with my computer or what. So it looks like you have a healthy dividend yield. You have a good amount of holdings, only 33, and you have a very low expense ratio. And it looks like you have it broken down into two slices in general dividend. I'm assuming this is individual companies, and dividend ETFs. All right, so 85, 15, okay, yeah, let's take a look at it. Your 30 holdings in here, you have a 3% dividend yield. That's really good. You got 15% in utilities. Okay, so you're 19 years old and you're investing in utilities at this high of a rate. It really depends on what type of utilities that you're invested in. Okay, so I'm a little bit skeptical, but we'll take a look. You got tech at 15, materials, finance, industrials. Okay, so let's see what kind of utilities you got in here. All right, so you got NextEra Energy in there, you got AQN, and you got VPU. I actually don't think this is bad. I think this is absolutely fine. You can see the performance. It's really strong performance. Utilities, they've kind of shot up these last couple of months. So I don't know if they're going to be able to, utilities as a whole are going to be able to sustain the share price that they currently have, given their earnings per share. So I don't know what that's going to look like. But long term, I think NextEra Energy is a fabulous investment, a fabulous utility. Let's take a look at, this is your tech. You got Verizon and tech. So Verizon's not really a tech company. This is a telecom company. Texas Instruments, Broadcom, and AT&T. So you got telecom and tech together. So you got AT&T and Verizon, which are both like pure telecom plays. Texas Instruments and Broadcom. Something that you might want to take a look at is maybe, look at Microsoft. Maybe look at Apple. Some of these other, growth-oriented technology companies, especially if you have a long time horizon. You said that you're only 19. It may make sense to look at higher growing companies like Microsoft. So let's take a look at your materials. You got Sherwin-Williams and you got APD. These are both really great companies. I think when it comes to materials, you picked two really high quality companies. These are really great. Let's take a look at your finance. Your finance is up pretty high. So you got Visa, US Bank, MasterCard, Main Street Capital, and CIM. I'm not actually familiar with CIM. But when it comes to Visa and MasterCard, I think these are absolutely great. Main Street Capital, yeah, it's fine. It's not my favorite, but it's fine. And US Bank. I personally like JP Morgan a little bit better, but I think as it stands, that's fine. Industrials, you got Union Pacific, Lockheed Martin, A.O. Smith, and 3M. Yeah, these are all really great. So you said that you want to invest into companies and industries that you feel are going to be here, in the future. I think Waste Management is one of the best companies out there that is predictable when it comes to the need and the demand, because as the population continues to grow, human beings, we create trash, right? And there's a lot of money in the trash business. And so something, maybe a company that you would want to check out. But all four of these are absolutely great. I also like Caterpillar if you wanted to take a look at one. Another one. Let's take a look at healthcare. You got Johnson & Johnson and you got AbbVie. Yeah, these are fine. Once again, it all really comes down to your personal preference. You don't have to invest into other companies, or maybe, I would even say it's probably a good idea to not invest into companies you don't understand. There's a lot of other great growth companies when it comes to the healthcare sector. Some of my favorites are Stryker and Medtronic. I really like those two growth companies. Let's take a look at consumers. You got PepsiCo, Hormel, you got Kimberly-Clark, and you got Costco. Okay, this is great. So Brandon, something that I would consider if I was in your situation, you're 19 years old, think about which industries you have the most understanding in. Consumer companies, you probably run into quite a bit, right? You probably go to Target, Walmart, Costco, wherever, and you buy consumer brands. Why not take a look the next time you go to the store? Take a look at your favorite brands. Look behind them and see which distributor creates or distributes that product that you're buying. And when you do that, and that goes for everyone watching the video, if you're a new investor, I think it's always a great idea to invest into companies that you're personally a fan of or a consumer of. And you can always adjust this later on, but I would highly encourage you, invest into companies that you understand or you have, you're familiar with, right? And so that's just a tip that I think would help every new investor. Let's take a look at your REITs. You got your diversified REITs, WPC, and good. This is really good. I have the exact same thing. Infrastructure REITs, DLR, Crown Castle, and AMT, also very good. And you got VNQ. Hey, Brandon, this is a fabulous slice. This is really good. Diversified REITs, infrastructure REITs. These, infrastructure is one of the highest growth sectors within REITs. You could also, once again, look at industrial REITs, really great growth ones as well. Okay, so let's take a look at your dividend ETFs. You got DHS, you got VYM, and you got QYLD. Interesting. So DHS, I don't see a lot, but I actually kind of like it. I like DHS a little bit better than SPHD. A lot of people talk about SPHD, but I actually like DHS a little bit better because of the actual holdings in the ETF. VYM is good. I really like SCHD as well. When it comes to QYLD, I would recommend checking out the video that I made about a month ago or 2 months on QYLD. I think it would probably make more sense for you and someone in your age group to check out JEPI or NUSI. I think QYLD maybe a little bit too soon for you to invest now into QYLD. So definitely something to take a look at. Well, Brandon, thank you so much for sending over your portfolio. I can tell based off of how you set up your portfolio, how you have the slicings, how you have it broken up, you absolutely know what you're doing. You have done a lot of research. This is not something that you just randomly put together. This is something that I see in people that have been investing for years. You're 19 years old. You're ahead of the game. I think this is absolutely great. Now it comes down to making more money, cutting your expenses, and looking for new ways to make more money. You're at a great age where you can side hustle, where you could buy a house and you could rent out the other rooms to your friends. It's called house hacking. There's so many great things that you can do. And if you do that, you might be able to reach your goal, or you might be able to reach financial independence very, very early in life earlier in life than most people. Brandon, thank you so much again for sending over your portfolio. All right, the last portfolio is from Michael. Michael writes, "Hi Jake, my name is Michael. I'm 22 years old and I just started investing in M1 Finance. I was using Robinhood before, but have now transferred to M1 Finance. I have about 11,500 invested in my portfolio and I'm looking to retire at 40. I'd love for you to check out my portfolio to see if I'm on track to financial freedom. Love your videos. I'm always excited when the new one drops." Michael, thank you so much, man. This is really, really kind of you to say that. You're 22 years old. You're learning about finance and investing. Man, you're years ahead of me. I wish I would have learned about this stuff when I was 22 years old. I would have been able to retire much earlier than I'm able to now. 40 years old is a great goal. That's 18 years. You're really off to a great start. So let's take a look at your portfolio. So I'm keeping in mind that you have about a 20-year time horizon, and that may change. It might go up, it might go down, but I think it's important to have that goal. Your portfolio performance is amazing, over 260%, very low expense ratio, 77 holdings, and you have a good dividend yield. So this portfolio is actually beating the S&P 500. When it comes to the last 5 years, you have, with your performance and the dividend yield, you're actually beating the S&P 500. And you have the same expense ratio as if you would have invested just into the S&P 500. So this is really, really good. Okay. The only thing that kind of concerns me is the 77 holdings. I just, with personal experience, it's very likely that you're going to be changing this up a bit, but it's something to be aware of. In my opinion, this is something that I had to learn. More is not always better when it comes to your portfolio. But let's take a look and see what you got under the hood here. So you got 20% allocated to technology, 20 to dividend ETFs, 15 to real estate. I like that. 15 to financials, 11 communication, healthcare 7, staples 7, industrials 4, okay, and utilities 1. Let's take a look at your technology. You got Apple, Microsoft, Tesla. This is probably a big reason why your portfolio is doing so well. VGT, NVIDIA, Amazon, Netflix, AMD, Google, and Intel. Okay, cool. So you got a lot of growth mixed in here with dividend growth. So you got your Apple, your Microsoft, and VGT. These are great dividend growth companies, as well as Intel. But you have some other growth stocks trickled in there. As you can see, 900%. Holy cow. I think this is fine. I think, having it in there is a great way to boost your overall portfolio performance. Let's take a look at your dividends. You got VYM, SPHD, SCHD, and SDY. Yeah, these all perform fairly similarly, where they're looking at the highest, dividend stocks in the S&P 500. I really am a big fan of VYM and SCHD. Those are my two largest holdings in my cash flow portfolio. SPHD is fine, not the biggest fan, but it's fine, and SDY as well. Okay, so let's take a look at your real estate. You got Main Street, you got Stag, Realty Income Gain. Okay, cool. DLR. Do you have good? Oh, you don't have good. So you got Gladstone, but you don't have good or land. Okay, DLR, Store, Crown Castle, Simon Property Group, and Blackstone Group. Okay, yeah, these are great. I think with this one as well, the industrial REITs with Prologis is definitely one that I would recommend. Although you do have Stag. Stag is a great industrial REIT that also pays monthly. This is one of my favorite REITs. So these ones actually, believe these ones all pay a monthly dividend, and these down here do not pay monthly. So you got a little bit of mixture of retail, you got specialty REITs and, cell towers, data centers. Do you have data centers? You don't have oh, you do have data centers. I'm blind. DLR. Okay, very cool. So you got really a great real estate portfolio there. All right, let's take a look at your financials. You got 11 holdings in Visa, MasterCard, Toronto, Royal Bank of Canada. These are really, really great banks. Canada, one thing that I will definitely say about Canada is their financial system is really, really great. You got Wells Fargo, JP Morgan, Bank of America, Morgan Stanley. So a lot of classical big time banks. You got Berkshire, which is, so the thing that I was going to ask was, okay, well, you don't really have a lot of insurance companies. Berkshire would be that insurance company or exposure. I think one that you could take a look at, investment companies like T. Rowe Price. You could look at Standard & Poor's. Those are the kind of things that you could take a look at. So you're very bank heavy and credit card heavy. So something to take a look at. There's also insurance companies out there that you could take a look at, or investment firms, though you do have, Morgan Stanley, for example. Okay, so let's take a look at your communication. You got AT&T, Verizon, Zynga, SiriusXM. I bought SiriusXM when I was living in Germany. I bought it for under $2 a share. I think now it's over $6. I sold out of it a long, long time ago, but I still remember back in the day owning SiriusXM. Crazy. You got Disney, Omnicom. Okay, cool. I'm not the biggest fan of AT&T, obviously now. You may have updated that since you sent the portfolio. I'm a big fan of Verizon. I like Comcast, the stock, and Disney obviously is great as well. Let's take a look at your healthcare. You got Johnson & Johnson, AbbVie, Pfizer, United Healthcare, Anthem. Yeah, these are all great. These are absolutely great. And your time horizon of 20 years, 2.7 dividend yield. I think it looks great. Man, this is easy. This is great. Let's take a look at your consumer staples, 10 holdings. Pepsi at the highest, Coca-Cola, Walmart, Costco, Home Depot, Clorox, Procter & Gamble, Cisco, Kimberly-Clark, and Philip Morris. Trying to think, you got the Procter & Gambles, you got the Kimberly-Clarks of the world. You really can't go wrong with this. This is just great. Okay, let's take a look at your industrials. You got your 3Ms, Lockheed Martin, Waste Management, probably my favorite stock of all time. I love Waste Management. I just wish they had a higher dividend yield. UPS, Honeywell, Caterpillar, FedEx, Republic Services. I don't see this a lot. This is another great waste management alternative. Emerson, Cummins, and Union Pacific. Yeah, man, this is a great portfolio. You definitely know what you're doing. Utilities, you got your Next Energy, your Duke, Southern Company, Dominion. This is very similar to my old portfolio before I adjusted it for my time horizon. When I set up my portfolio a little over a year ago, my time horizon was 10 years. And then with the real estate appreciation, we bumped up our financial independence timeline by 5 years. So my portfolio used to look a lot like this. Yeah, man, I think this is fine. If you ever, so one thing that you could consider, if you're not really familiar with these companies and you don't want to follow up on these companies, what you could do is you could take out, this is just something you could consider, you could take out a few of these and just take a look at the Vanguard industry, the utility industry ETF in ticker symbol VPU. And that would be a great way to get exposure to all of these companies through one ETF. Something that I've recently done, and I love it. Michael, I can say that this is an amazing portfolio. You know what you're doing. The only thing that I'm a little bit concerned about is the number of holdings. And I mean, it's not that big of a deal. You're young, but what I would make sure that you understand that the benefit of a dividend portfolio is the long-term potential to compound and grow. Now, you do have a little bit of a mixture portfolio here where you do have a lot of growth stocks in this portfolio, especially in the technology slice. So I can understand that. Over the next 20 years, you're probably going to naturally gravitate towards those companies that you know the most about. So I wouldn't be surprised over the next coming years that this number goes down. In my opinion, before you ever increase this, you probably should even consider decreasing it as you learn more about these companies. I think that is something that you're going to notice on your own over the next coming years. And so because you have growth inside of this portfolio, you're probably going to be a little bit more hands-on. That's why I personally like having the growth in a completely separate slice altogether, because I manage growth a little bit differently than I do with my dividend stocks. Michael, I hope that this was helpful. Thank you so much for sending over your portfolio. As I mentioned, this week has been a little bit crazy with traveling and everything with the baby. It's the first time that we've gone on a trip here in the last year and a half, and the first time ever with a little baby in the back. So it's definitely going to be an experience. I'm going to do my very best next week to upload another video as well. But yeah, thank you so much everybody for watching, and I'll catch y'all in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.